I still remember the exact moment. It was late at night. The room was quiet. The chart was open on my screen, glowing softly in the dark. I had taken the trade with confidence. The setup was clean. The logic made sense. Everything aligned the way it should. And then, price moved against me. At first, it was just a few ticks, nothing serious. I told myself to stay calm. This is normal, I thought. Markets breathe. But then it kept going, slowly, relentlessly. That was the moment something inside me changed. Not on the chart, inside my chest. My breathing became shallow, my eyes stopped blinking. My hand hovered over the mouse, not because I knew what to do, but because I didn't. And that's when I realized something most traders never talk about. The real battle doesn't start when you enter a trade. It starts the moment price goes the wrong way. Because when a trade runs against you, the market isn't just testing your analysis, it's testing your identity. You feel it immediately, that tightness in your stomach, that urge to do something, to adjust the stop, to add another position, to prove that you were right. And underneath all of it is a quiet, dangerous thought. What if I'm wrong? This video is not about indicators. It's not about entries or exits. It's about that moment when the chart turns against you and your emotions begin to take control. Because if you've been trading long enough, you already know this truth. Most accounts don't blow up because of bad strategies. They blow up because of emotional decisions made while the trade is bleeding. Years ago, I didn't understand that. I thought emotional control meant staying calm, staying disciplined, following the rules. But emotional control has nothing to do with forcing yourself to feel calm. It has everything to do with understanding why the market triggers you the way it does. I want to take you back to a period in my life when I learned this lesson the hard way. I had been trading for several years by then, enough to know the basics, enough to believe I was past the beginner phase. My win rate was decent. My strategy was consistent. On paper, I was doing everything right. But emotionally, I was fragile. Every time a trade went against me, it felt personal. Not because of the money, but because of what the trade represented. I didn't just see a losing position. I saw a judgment on my intelligence, my experience, my worth as a trader. When price moved in my favor, I felt validated. When it moved against me, I felt exposed. And that emotional attachment is subtle. It doesn't scream, it whispers. It tells you to give the trade a little more room. It tells you the market is just shaking out weak hands. It tells you that closing now would mean admitting defeat. So you stay. And the longer you stay, the harder it becomes to leave. I remember one trade in particular. The setup failed almost immediately. Clean invalidation, textbook exit. But I didn't take it. I watched price move deeper into loss while telling myself a story about patience, about market manipulation, about how the move didn't make sense. The truth was simpler. I didn't want to accept being wrong. By the time I finally closed the trade, the loss wasn't just financial, it was psychological. I felt drained, ashamed, disconnected from the chart. And that was the night I understood something crucial. Emotions don't spiral when price goes against you. They spiral when your self-image is tied to the outcome of the trade. That realization didn't come from a book. It came from pain, from repetition, from watching myself make the same mistake again and again. I began to notice a pattern. Whenever I felt the strongest urge to interfere with a trade, it wasn't because the market was doing something unusual, it was because I was. The emotion didn't start with the red candle. It started with the expectation I placed on the trade before I entered. I expected it to work. I expected the market to confirm my view. I expected to be right. And expectations are dangerous in trading. because the market doesn't care what you expect. It only cares about liquidity, structure, and probability. The moment I understood that, something shifted. I stopped asking, why is the market doing this to me? And started asking, what part of me is reacting to this move? That question changed everything. Because emotional control isn't about suppressing fear or frustration. It's about recognizing the psychological trigger before it hijacks your decision-making. And when a trade runs against you, the trigger is almost always the same. It's the fear of being wrong. Not on the chart, wrong on yourself.
There's a quiet moment in every losing trade. It's the moment right before you touch anything, before you move the stop, before you close the position, before you add size to average in. That moment is where most damage is done. Because the mistake isn't the emotional reaction itself. The mistake is acting while the emotion is still driving. For a long time, I believed the problem was fear or panic or impatience. I thought if I could just control those feelings, I'd trade better. That belief was wrong. The real mistake wasn't the emotion, it was the meaning I assigned to the trade. When a trade went against me, I wasn't reacting to price, I was reacting to what the loss symbolized. A loss felt like proof. Proof that I didn't understand the market, proof that I wasn't as skilled as I thought, proof that the years I'd spent learning might have been wasted. That's why the pain felt disproportionate. The chart wasn't attacking me, my ego was defending itself. Once I saw that clearly, something uncomfortable became obvious. Every emotional reaction I had during a losing trade followed the same sequence. First, denial. This move doesn't make sense. Then, justification. The setup is still valid if I zoom out. Then, hope disguised as patience. I'll give it a bit more room. And finally, paralysis. Staring at the screen, unable to act, watching a manageable loss turn into something heavier. This wasn't a trading problem, it was a psychological pattern. And patterns don't disappear just because you want them to. The turning point didn't come from a new strategy or a tighter stop. It came from a single realization that hit me harder than any losing trade. When a trade goes against you, the market is offering you information. Your emotions are offering you a mirror. That was the revelation. The loss itself wasn't the enemy. The enemy was my resistance to accepting uncertainty. I had built an identity around being right, around reading the market correctly, around being the guy who could see what others missed. So when price moved against me, it wasn't just a trade failing, it was my identity being challenged. And identity will always fight back. Once I saw that, I stopped trying to control my emotions. Instead, I started observing them. I noticed how my body reacted the moment price crossed a certain level, how my breathing changed, how my thoughts narrowed. Those sensations became signals, not signals to act, signals to pause. That pause became the most powerful tool in my trading. I began to treat emotional spikes the same way I treated volatility spikes, as conditions that required distance, not action. If my emotions surged, I did nothing. No clicking, no adjusting, no reacting. I gave myself space to let the feeling pass. And here's what surprised me the most. Emotions, when not fed by action, fade quickly. Fear loses its grip when it's not rewarded with interference. Frustration dissolves when it's not given control. Over time, I realized something even deeper. The market doesn't punish you for being wrong. It punishes you for refusing to accept being wrong. Every time I respected my exit, even when it hurt, I reclaimed a piece of control. Not over the market, over myself. That's when trading began to feel different. Losing trades no longer felt like failures. They felt like data. Information about probability, information about conditions, information about myself. And the irony is this: the moment I stopped trying to avoid emotional pain, I stopped creating it.
At some point, I stopped asking how to control my emotions. I started asking a different question. Why does a losing trade feel so unbearable in the first place? Because if you strip away the candles, the indicators, the jargon, what's really happening when a trade goes against you is simple. You are experiencing uncertainty without control, and the human brain hates that. The market is one of the few environments where you can do everything right and still be wrong, where effort doesn't guarantee outcome, where intelligence doesn't protect you from loss. That alone is enough to trigger stress. But retail traders experience something even worse. They experience asymmetric information. Smart money understands this very well. Institutions, funds, professional desks, they don't enter trades expecting certainty. They enter expecting variance. Loss is already accounted for before the trade exists. Retail traders do the opposite. They emotionally price in the win before the trade even triggers. That's why the pain feels sudden and overwhelming when price moves against them. They're not losing money in real time. They're losing a future they already imagined. You can see this clearly in how most retail traders place their stops. Stops are not positioned where the trade idea is invalidated. They're positioned where the trader can emotionally tolerate being wrong. And that's a critical difference. Because when price approaches that emotional boundary, the trader feels threatened. Not financially, psychologically. This is where emotions take over. Let me give you a real scenario I've seen hundreds of times. A trader enters a long position at a perceived support level. The stop is placed just below it. Clean, logical, on paper. Price drops, slowly. As it approaches the stop, volume decreases, volatility compresses. Nothing dramatic. But inside the trader, everything is loud. Thoughts accelerate. Time distorts. The chart feels aggressive even though it isn't. This is the moment smart money often exploits, not because they know where your stop is exactly, but because they understand human behavior around loss. Liquidity pools exist where traders feel the most emotional pressure. Smart money doesn't hunt stops. They hunt certainty-seeking behavior. They know retail traders will cluster their exits around obvious levels. They know emotions peak at those points. And they know that emotional traders provide predictable liquidity. When price pushes through those levels and then reverses, retail interprets it as manipulation. But from the insider perspective, it's simply structure meeting psychology. Now here's the insight most traders miss. The emotional pain you feel when price runs against you is not random. It's proportional to how much certainty you demanded from the trade. The more you need the trade to work, the less tolerance you have for drawdown. That's why over-leveraged trades feel unbearable even with small adverse moves. The leverage amplifies not just risk, but emotional exposure. This is why professional traders reduce size before volatility, not because they fear loss, but because they understand emotional bandwidth. You cannot think clearly when your nervous system is overloaded. And thinking clearly is the only edge retail traders can realistically build. Another pattern I noticed over the years is how traders confuse patience with emotional avoidance. They tell themselves they're being patient, but what they're actually doing is delaying a decision they don't want to make. Patience is intentional. Avoidance is emotional. When a trade goes against you, patience looks calm, observant, detached. Avoidance feels tense, hopeful, narrative-driven. Smart money never waits in hope. They wait in neutrality. There's a difference. This brings us to the most uncomfortable insight of all. Most traders don't lose control when trades go against them because they lack discipline. They lose control because they never accepted the probabilistic nature of the game at a visceral level. They understand probability intellectually, but emotionally they still expect certainty, and the market will always punish that mismatch. Once I truly accepted this, my relationship with losing trades changed completely. I stopped asking how to fix my emotions. I started designing my trading to respect them. I reduced size. I widened invalidation levels. I stopped entering trades that required emotional endurance to survive. And suddenly, emotions stopped spiking. Not because I became tougher, but because I stopped putting myself in situations that demanded emotional strength. That's how smart money really thinks. They don't train themselves to endure pain. They structure their exposure so pain doesn't hijack decision-making in the first place. That's the real edge. Once I understood that emotional control wasn't about strength, but about structure, everything began to slow down. Not the market, my reactions. I stopped trying to be brave inside losing trades. I started designing trades that didn't require bravery at all. The first change was size. I realized that whenever a position felt emotionally heavy, it was usually oversized, not in terms of account percentage, but in terms of psychological weight. I had given the trade too much importance, too much meaning. So I reduced size until I could watch price move against me without feeling the urge to intervene. That became my baseline. If I couldn't sit with a losing trade calmly, the size was wrong. No exceptions. The second change was clarity of invalidation. I stopped asking where my stop should be and started asking where my idea was truly wrong. If I couldn't explain in one sentence why the trade would be invalidated, I didn't take it. And if the invalidation point required me to emotionally hold on through noise, I walked away. Clarity removes emotional bargaining. When you know exactly where you're wrong, there's nothing to negotiate with. The third change was pre-acceptance. Before entering any trade, I began doing something that felt uncomfortable at first. I imagined the loss. Not dramatically, not emotionally, I simply accepted it. I told myself very clearly, if this trade fails, nothing about me changes. Not my intelligence, not my experience, not my future in trading. That single sentence removed more emotional pressure than any rule I'd ever written. Because most emotional reactions come from resistance to loss, not the loss itself. When you accept the loss before it happens, the market loses its ability to threaten you. Over time, I noticed something subtle but powerful. Losing trades no longer lingered in my mind. They didn't follow me into the next setup. They didn't distort my perception. They ended where they should, on the chart. That's when I knew I was no longer trading to prove something. I was trading to participate. And participation is calm. Participation doesn't need validation. It doesn't chase certainty. It doesn't panic when price goes the wrong way. It simply responds. If there's one lesson I want you to take from this, it's this. When a trade runs against you, your emotions are not the problem. They are feedback. They're telling you where your expectations are misaligned with reality. They're showing you where your identity is attached to outcome. They're pointing directly at the part of you that still demands certainty in an uncertain game. Listen to that signal. Don't fight it. Don't suppress it. Don't obey it. Just observe it. Because the trader who survives long enough to master the markets is not the one who never feels emotion. It's the one who no longer lets emotion make decisions. If this resonated with you, take a moment and reflect on your last losing trade. Not the entry, not the setup, but the moment price went against you. What did you feel? What did you tell yourself? And what did you do next? That answer will tell you far more about your trading than any indicator ever could. If you want to continue this journey, understanding not just the market, but yourself, subscribe to Staro Trading. This channel isn't about chasing wins. It's about building clarity, resilience, and longevity in a game designed to test you. And remember, master yourself, master the markets.